Imagine you're a regular investor logging into your brokerage app on a quiet morning. You decide to buy 100 shares of your favorite company and click buy. Within the blink of an eye, your order confirms. It feels simple and instant. What you don't see is that behind the scenes, a swarm of algorithmic trading bots noticed your order and reacted in microseconds, trading thousands of shares while you were still waiting for your confirmation. In fact, if you ever bought or sold a stock, there's a good chance a computer was on the other side of that trade. These bots have become the unseen characters in our markets, operating so quickly and quietly that most of us don't even realize they're there. Hello, and welcome to A New Lens. I'm your host, Wild Will, and today we're exploring The Bots Are in the Market, how algorithmic trading skews the game. We'll shine a light on how algorithmic trading bots work in the stock market and why their widespread use may be harmful to average investors. So, let's start with that trade you just placed. You might picture a Wall Street trader on the other end, but more than likely it's a computer program. Some have even described these trading programs in vivid terms. One popular book compared a high-speed trading algorithm to a tiger that lurks in the woods and waits for the prey, then jumps on it. It's a striking image, the prey being regular investors like you and me, and the predator a super fast bot hunting for profit. The predatory image still lingers for many observers. It leads to a nagging question. Is the stock market a fair playing field for the average person, or have these ultra-fast bots skewed the game in their favor? Let's pull back the curtain on what these trading bots actually are. At their core, they're computer programs, algorithms, that automatically execute trades based on preset rules. Instead of a human clicking buy or sell, the algorithm does it on its own. Crucially, it does it much faster and on a much bigger scale than any human could. In industry lingo, this is high-frequency trading, often called HFT for short. These automated systems scan the market and send out orders in fractions of a second, aiming to capitalize on tiny opportunities. Often, they're designed to make just a tiny profit on each trade, maybe a fraction of a penny. But through sheer speed and volume, those pennies can snowball into hefty gains for the firm running the bot. How fast are we talking? Today's trading computers execute transactions in mere milliseconds or even microseconds. For perspective, a blink of your eye takes about 400 milliseconds. In that time it takes you to blink, a high-frequency trading bot could potentially execute thousands of trades. In other words, if these bots operate on a timescale so small that it's almost unfathomable to us, speeds far beyond human reaction time. They place orders at blinding velocity, earning high-frequency trading a reputation as algo trading on steroids. What do these speedy algorithms actually do? In many cases, they're engaging in arbitrage or market-making strategies. For example, they might instantly spot that a stock is priced slightly higher on one exchange than another and swoop in to buy low and sell high, profiting off the tiny price discrepancy. The goal is to snatch minuscule gains from fleeting price differences before those differences disappear. Unlike a traditional investor who might hold a stock for months or years, a trading bot might hold it for a few seconds or less. It's trading in and out over and over, skimming little profits from each round-trip trade. Multiply those small profits by millions of trades, and you can see why firms invest heavily in these systems. In fact, there's an all-out technological arms race to be the fastest in the market. High-frequency trading firms spend vast sums on cutting-edge tech to gain an edge of a few microseconds. They colloquiate their servers right next to stock exchange servers, often paying a premium for that privilege, and even use microwave or laser communication links to shave off signal travel time. One industry insider quipped that HFT firms are constantly scrounging to save a millisecond or nanosecond at every level of their hardware and networking. To give you an idea of the lengths they go, in 2010, a group of traders secretly spent about $300 million laying a specialized fiber optic cable in a straight as a line as possible between Chicago and New Jersey just to cut down communication by a few milliseconds. When that wasn't fast enough, firms moved on to microwave towers and even exotic laser systems, all to be the first to react to market information. Clearly, speed isn't just an advantage in this game, it's an obsession. With such incredible speed and automation, some argue these trading bots have made markets more efficient. The bots can provide lots of liquidity, meaning they're always ready to buy or sell, which can tighten the bid-ask spreads and in theory help everyone get better prices on their trades. In an ideal world, the algorithms act like diligent market makers, greasing the wheels of trading and reducing costs for investors. However, as we'll see, this high-frequency automated trading can also introduce serious downsides. When something moves this fast, things can go wrong fast, and the effects ripple through the market in ways that can hurt regular people. One of the biggest concerns about algorithmic trading bots is how they affect market volatility and fairness. We've all seen stock prices zigzag, but with the bots in the mix, those swings can become more extreme. Why? Because these algorithms all react the same. To the same signals, and they react instantly. If one bot starts selling because the market is dropping, others may see a sudden move and sell even faster, creating a rapid domino effect. In turbulent moments, many algorithms will actually widen their bid-ask spreads and just stop trading altogether to avoid losing money, which drains liquidity right when it's needed most. With fewer active buyers and sellers, prices can free fall even more violently. In other words, during a panic, the bots may hit the brakes and vanish, leaving the market to spiral with almost no floor. This amplifies those stomach-churning swings that leave investors scratching their heads. Research indeed shows that algorithmic high-frequency trading is a notable contributor to exaggerated market volatility. When markets suddenly collapse or spike for no clear reason, it's often these lightning-fast trading programs piling on. Investors are left wondering what on earth just happened, because news alone doesn't explain such a dramatic move. And during the confusion, big HFT firms often pull back further to manage their risk, which puts even more downward pressure on prices. It's a feedback loop. A quick drop triggers bots to withdraw or sell, which makes them drop worse, which triggers more bots, and so on. By the time humans figure out what's happening, the damage is done. We don't have to theorize about this. We've seen it in real life. The most infamous example was the flash crash on May 6, 2010. On that day, the stock market went into sudden freefall. Major U.S. Indices plunged about 5 to 6% within minutes and just as quickly bounced back. The Dow Jones Industrial Average dropped nearly 1,000 points in the blink of an eye. At the time, its largest intraday point drop ever. Some of the biggest blue-chip stocks like Procter & Gamble briefly traded for mere pennies, and others shot up to absurd prices like $100,000 a share amidst the chaos. It was as if the entire market had a nervous breakdown for about 20 minutes. So what caused it? Investors found that it started with a single large trade by a mutual fund, a massive $4.1 billion sell order on an E-mini S&P 500 futures contract. That one big algorithmic order hit a thinly populated market and triggered a chain. Trading bots saw the selling and immediately began selling too, either to cut losses or exploit the downward momentum. One algorithm after another, like falling dominoes, amplified the sell-off in a matter of seconds. The SEC described it as a cascading effect. One algorithm's rapid-fire selling set off another, creating a financial snowball rolling downhill. Stocks and ETFs were being bought and sold at crazy prices because the usual safeguards, like human judgment or sufficient buy orders on the other side, just weren't there. It only stopped when automatic trading pauses kicked in. In the aftermath, regulators put in new circuit breakers in place, rules that halt trading in a stock if its price moves too far too fast, to prevent such sudden crashes from spiraling out of control again. Still, that day was a stark demonstration of how bot-driven volatility can rattle the market and everyone in it. Extreme events aside, there's also the everyday fairness question. Is the average investor at an inherent disadvantage in the market dominated by these algorithmic speed demons? Many believe the answer is yes. The playing field clearly isn't level when one participant can trade in microseconds and the other is hitting refresh on a screen. A revealing study by former regulators found that high-frequency trading firms actually made higher profits when trading against small retail investors than they did against large institutions. To put it plainly, when a trading bot is up against an amateur investor, it tends to earn more money, essentially extracting value from that retail trade. This suggests these algorithms are particularly adept at profiting off the little guy, whether by anticipating their moves or exploiting tiny price advantages before the retail order is completed. It doesn't help that confidence problem that HFT firms operate in a bit of a black box. Their tactics aren't very transparent, and that fuels suspicion. If you're an average person, you might reasonably ask, am I trading in a market that's subtly stacked against me? Even the supposed benefits, like increased liquidity, don't always feel tangible to regular investors. Sure, spreads might be a penny tighter thanks to HFT, but that's cold comfort if a sudden bot-induced crash just triggered your stop-loss orders and sold your stocks at rock-bottom prices. In the flash crash, many investors with automatic stop losses saw their shares sold for cents on the dollar, only for those stocks to recover minutes later. A nightmare scenario. Episodes like that shake people's faith in the market's integrity. If the prices can go haywire without warning because of algorithms, who wants to risk their retirement fund on that casino? In fact, observers worry that repeated bouts of unexplained volatility might drive away everyday investors entirely. The stock market only works if people trust it's reasonably fair and stable. When trust erodes, it's bad for everyone. It's worth noting that defenders of high-speed trading argue that these algorithms also provide service to the market. They add liquidity, lower transaction costs, and help tighten spreads, as mentioned earlier. And there is truth to those points in normal day-to-day conditions. The controversy lies in those not-so-normal moments and in the overall power dynamic. The benefits of algos can feel abstract, while the potential harms, like flash crashes or the sense of an uneven game, feel very real. Regulators have struggled with these trade-offs. How do you keep markets efficient and technologically up to date without letting them turn into the Wild West where only the fastest gunslingers win? To really understand the impact of trading bots, let's quickly revisit a couple of real-world events. We already talked about the 2010 flash crash, a dramatic case of algorithms going awry. But there have been other incidents too, highlighting different ways things can go wrong. Take the story of Knight Capital. Knight Capital was a large Wall Street trading firm and market maker. On the morning of August 1, 2012, Knight activated some new trading software, and immediately things spiraled out of control. A flaw in their algorithmic system started rapidly buying and selling stocks in error. In the span of about 45 minutes, Knight's computers executed millions of mistaken trades across 150 different stocks. The firm found itself accidentally buying huge volumes of shares that it didn't actually want. Prices of some stocks were whipped upward by this sudden buying pressure, and then, when Knight realized the screw-up and frantically sold off those shares, the prices whipsawed back down. This one buggy algorithm wreaked havoc in the market that morning. By the time the dust settled, Knight Capital had lost around $440 million in that brief half hour, a staggering blow that nearly bankrupted the company. In fact, rival trading firms noticed Knight's erratic trades and reportedly swooped in to take advantage of the mispricing, which is the merciless logic of the market. Knight had to be bailed out by a group of investors and was eventually acquired by a competitor, all because of an algorithmic glitch. This case showed that it's not only malicious algorithms that pose a risk. Even a coding error in a trading bot can unleash chaos and huge losses at a mind-boggling speed. There have been other smaller flash crashes and odd price spikes attributed to algorithmic trading over the years. For instance, in 2013, a hacked news tweet about the White House caused bots to briefly tank the market before bouncing back. In 2015, certain exchange-traded funds, or EFTs, experienced a mini flash crash amid heavy algorithmic trading at the market open. Each time, it's a similar pattern. Something triggers automated programs to trade in unison, liquidity vanishes for a few moments, and prices swing intensely until humans or safeguards step in. These events are like ghosts in the machine, rare but frightening when they appear. They remind us how tightly interwoven our markets have become with algorithms, and how even well-intentioned algos, or innocent mistakes, can misfire in a big way. Beyond volatility, there's another dark cloud in this story: market manipulation. The stock market has rules against practices like spoofing, layering, front-running, and other forms of cheating. However, the speed and complexity of algorithmic trading can sometimes be used to game the system in ways that are hard to detect in real time. A particularly eye-opening example was the case of Navinder Singh Sarao, a lone wolf day trader who used algorithms to influence the market. Sorrow employed a tactic known as spoofing. Here's how spoofing works. A trader's algorithm floods the market with a huge number of fake orders, say orders to sell a stock, with no intention of actually filing them. These fake orders trick other traders and trading bots into thinking there's a big sell pressure building. When you can push the price down, and then the program would quickly cancel all those fake sell orders before they executed. At the same time, he'd be buying that stock at the now lower prices. Next, he'd flip the strategy, placing large fake buy orders to drive the price back up, cancel them, and sell the stock he bought for a profit. Rinse and repeat. It's essentially bait and switch on a grand scale, done at computer speed. Sorrow did this on a stock index futures, and his spoofing was so extensive that US authorities said it contributed to the 2010 flash crash turmoil. He was eventually caught and pleaded guilty to market manipulation charges. The fact that one person with a computer program could send tremors through the entire stock market is pretty unsettling. Sorrow's case is an extreme example, but it underlies a point. Algorithmic systems can be abused. Even some sophisticated high-frequency trading firms have crossed the line. In recent years, regulators like the SEC have fined certain HFT firms for manipulative tactics and other fraudulent trading behaviors. This includes things like quote stuffing, where a firm sends tons of orders and cancels them just to confuse or slow down other participants, or pinging dark pools, which is using small test trades to sniff out big hidden orders. The arms race nature of HFT can create an environment where a few bad actors might try to use their speed advantage in nefarious ways. Policing this is tough because regulators are effectively trying to catch lightning fast misconduct after the fact. It's a bit of cat and mouse game between those writing the trading algorithms and those writing the rules. Now let's talk about barriers. If all this makes you think the game is tilted in favor of big institutions running fancy algorithms, you're not alone. To participate in high-frequency trading, one needs enormous resources, ultra-fast data connections, expensive hardware, access to exchanges, and highly skilled quantitative developers. The firms that dominate this space have spent millions, even hundreds of millions, on infrastructure to be a split second faster than everyone else. Obviously, Joe Schmo with a $5,000 E-Trade account can't compete at that level. Retail investors are effectively barred from this high-speed arena. They can't afford to colloquiate servers next to the NASDAQ or develop microwave networks between Chicago and New York. This creates a two-tier market, the high-speed club and everyone else. The high-speed club doesn't just trade faster. They often get subtle advantages like being first in line for order data or receiving rebates from exchanges for providing liquidity. Meanwhile, retail orders are frequently routed through wholesalers, many of which are HFT firms themselves, who profit from executing those orders internally. There's an ongoing debate about whether that practice, known as payment for order flow, benefits retail traders with slightly better prices or if it just allows insiders to monetize retail trades. But at the very least, it's clear that the average investor is swimming in a pool where there are sharks and they don't even see them. Studies suggest that current setup is indeed a winner-take-all environment, in which a handful of HFT firms reap most of the profits. Those profits, as noted, often come at the expense of other traders, which often means regular investors. It's not that the retail investor can't make money in the stock market. Many do, of course. It's that the process of trading is subtly taxed by those who can consistently trade a step quicker and smarter. Over time, that can feel like running a race where someone else always has a head start. Michael Lewis's book, Flash Boys, encapsulated this sentiment by suggesting the stock market was rigged by HFT, a claim hotly disputed by the industry, but one that resonated with many people. When everyday folks hear about the lengths high-frequency trades go to, like the $300 million cable for 1 millisecond advantage, it sure sounds like the big players have built themselves a turbocharged highway to riches, while everyone else is stuck in traffic. All these concerns have prompted regulators and exchanges to consider reforms. Ideas like taxing trades that are held only for a few seconds or introducing random delays, a speed bump to level the playing field, have been floated. Some exchanges, like the IEX featured in Flash Boys, were founded on the promise of fairer trading with built-in speed bumps to blunt the HFT advantage. The New York Stock Exchange and NASDAQ have also periodically adjusted rules to curb the most egregious bot behaviors. But it's a tricky balance. You don't want to outlaw algorithms altogether since they do provide liquidity and other benefits. The goal, ideally, is to rein in the abusive practices while keeping the positive aspects of automation. As we wrap up, let's take a step back and look through a new lens at what we've learned. The rise of algorithmic trading bots has fundamentally changed the stock market's ecosystem. In many ways, it's an incredible story of innovation. Brilliant engineers and mathematicians pushing technology to trade in millionths of a second, finding inefficiencies and arbitraging them away, making markets globally interconnected, and in normal times, ultra efficient. But there's a flip side. This new speed of light market can behave in ways that feel alien and perilous to the rest of us who rely on it for our 401ks and college savings. It can have sudden air pockets of volatility that hit without warning. It can foster an environment where those with the best tech win, not just by skill or insight, but by sheer speed. And it can leave the typical investor wondering if the game is subtly rigged against them. So, is the answer to ban bots, slow them down? Or do we just accept them as the new normal and adapt around them? There's no consensus yet. What we do know is that they're not going away. As one commenter noted, high-frequency algorithmic trading is well established in today's markets, and it's here to stay. The key will be figuring out how to ensure fairness and stability in this high-tech arena. Policymakers, exchanges, and trading firms are still working that out, more than a decade after the flash crash sounded the alarm. For you as an investor, perhaps the takeaway is this. Next time you place a trade or see a sudden sharp move in stock price, remember that an army of bots is out there, clicking buy and sell 1,000,000 times a second. The market isn't just people yelling on a trading floor anymore, it's largely machines racing in virtual silence. That knowledge can be a little disconnecting, but it's also empowering, because understanding the forces at play is the first step in navigating them. We hope this episode has given you a clearer picture of how algorithmic trading bots work and why they can pose challenges for regular investors. Like many innovations, they bring both benefits and risks. The story of trading bots is still being written. It's a story of both ingenuity and caution. I'll leave you with a question to ponder. In a market run by machines, what role should humans play to keep things fair and sane? It's a question regulators, traders, and investors are all grappling with, and one that doesn't have an easy answer just yet. Thank you for listening to A New Lens. We've looked at the bots in the market today, and hopefully it's given you a new perspective on those rapid-fire trades that make financial worlds tick. Until next time, keep asking questions and keep looking at the world through a new lens. Stay curious and informed.